Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. Did you know that about 90% of short-term traders lose money in the stock market? Like it or not, the short-term movements of the market are random, and it's a lot like a casino. Learning to keep the odds in your favor and money management will help you be a better trader and become the casino. Right. Let's talk about this. Okay, so how does the casino make money? Easy. They always have the odds slightly tilted in their favor. If we take a game like roulette, and if the wheel has only 36 numbers on it, where 18 are red and 18 are black, then the casino would have a 50% chance of winning, and a player would have a 50% chance of winning. With all things being equal, the casino nor the player would make any money, and this would be the same odds as flipping a coin. However, the casino adds 2 green numbers to the wheel, and now this tilts the odds of winning in the casino's favor. The casino now has a 53% chance of winning, and a player has a 47% chance of winning. If a player was to now bet $100 for 100 games, the casino would win $5,300 and the player would win $4,700. Over time, this allows the casino to make more and more money. At this point, a lot of people think that all they need to do is to find a trading strategy that wins slightly more than 50% of the time and they'll make money. Unfortunately, this is not true. In fact, a strategy that has a win rate of 80% can still lose money, and conversely, a strategy with a win rate of 30% can still make money. This is where the risk-to-reward ratio is important. Looking at a risk-to-reward ratio table, it shows what the minimum win rate would need to be in order for a strategy to make money. As you can see, a strategy with an 80% win rate can lose money if it loses more than 4 times what it wins. For example, if we bought a call option for $1,000 and it has a probability of profit of 40%, we would want to look at a stop loss of about $200 and a profit target of about $400. This would give us a risk-to-reward ratio of 1 to 2, which would match our minimum requirements and make the strategy successful. Understanding the relationship between the win rate and the risk-to-reward ratio will greatly improve a trader's success. Profitable trading happens with a high win rate and a high risk-reward ratio, or a low win rate and a low risk-to-reward ratio, but the magic happens with a high win rate and a low risk-to-reward ratio. The danger zone is when you have a low win rate and big losses, or a high risk-to-reward ratio. This leads us to the next important point of managing your winners and, more importantly, your losers. Professional traders always enter a position knowing what their maximum risk is before placing a trade. Trading losses will happen, and if you have a losing trade that is not working out, then you must learn to cut your losses and move on. Holding and hoping a position will win is not a strategy. Gamblers' ruin can make recovery from large losses very difficult. Many people think that if they lose 10% on a trade, they will only need to make 10% on the next trade to make up for the loss. Unfortunately, this is not true. In fact, the next trade will require a return of 11.1% to get back to break even. A 20% loss on a trade will need you to make a 25% gain on the next trade to break even, and a 50% loss will need a 100% gain to break even. The larger the loss, the more you'll need to make up on your next trade to get back to break even. Gambler's ruin demonstrates that if you're not ruthless about cutting your losses, it leads to a very slippery slope. Finally, allocating the correct amount of capital per trade also needs to be considered. Strings of losses can happen, and incorrect position sizing will not allow you to ride out a run of bad luck, and an account can blow up. The amount allocated to a trade should be approximately 3% of your account size. If you have a small account with less than $10,000, then making a reasonable return will be difficult. With a smaller account size, you may want to allocate between 3% to 5% per trade. A larger account of $20,000 or more can have an allocation of 1% to 3% per trade. In summary, understanding the relationship between your strategy win rate and the risk to reward ratio is vital to being a successful trader. Be ruthless with a trade that's not working out and cut your losses before things spiral out of control. Proper trade size allocation will help you ride out a string of losses and keep you in the game and help you to trade like a casino. If you have enjoyed this video, then please click the subscribe and the like buttons. This shows support for my channel and you'll be notified when the next video is released. Thanks for watching, and I'll see you in the next video.